Hi everyone, Miles here. Today we're going to go over the 5 factors that affect your credit score. So I'm in PowerPoint, I'm in the presenter view, and I just want to go over these factors. So I have this title screen, the 5 factors that affect your credit score, and then right here. So once you have your first credit card like the Capital One Platinum, Chase Freedom, the American Express Everyday, you will need to build your credit score to help you get basically other better cards. My personal favorite, it's really got to be the Platinum. It's probably one of the easiest cards to get if you pay on time for 6 months, which means you pretty much got to buy a cup of coffee on it and pay it off for 6 months. They'll give you a limit increase. I think that's really, really cool. I mean, it just opens the door with Capital One. They got some good cards like the Venture, which I love and have used for many years. And also, good starter cards are the Chase Freedom. One of the easiest ways to get approved for this card is to bank with Chase and have a personal banker write your letter of recommendation for the card that your account's current, you're paying your bills on time, etc. And the American Express Everyday, great card to get your foot in the door with American Express. If I were to start over with the knowledge I have now, I would probably just go for these 3 for the first 6 months of building my credit. Then I would add on maybe 2 other Chase cards like the Preferred or the Flex, just to or the Freedom Unlimited, just to have more Chase cards. So we're going to go over the 5 factors. The 5 factors are payment history. That's 35% of your credit score. A late payment can drop your score about 120 points. In the credit card industry, I see this all the time. It's very, very sad. Some of the people that we come across, one late payment after years of being great, bam, right in the 500s. So that's very unfortunate. Number 2 is credit utilization. How much credit you're using in comparison to your overall credit line. So that would be if you had $10,000 of credit available across all your credit cards, and let's just say you have $1,000 of that spent. I'll actually go over this example in another video, so let me get that for you. We have person 1. They have a credit limit of $300 and they spend $200. Now the utilization reports at 66%. That's not favorable. That can hurt your score up to 50 to 70 points. Person number 2, credit limit $1,000. They spend $400. Their utilization is 40%. That's listed as favorable, but I would prefer everyone be under 30%. And number 3 is credit history. Credit history is the age of accounts. How old are these credit card accounts? Number 4 is credit inquiries. How many times has a lender ran your credit? And then the types of credit used. So payment history. We're going to go over this one first. It's 35% of your credit score. You need to meet the minimum payment or pay the card in full so you don't incur a late payment. I would suggest paying your card a couple times a month and making sure it's paid off maybe 5 to 7 days before the statement is due or the payment's due. Don't pay interest. You're wasting your money if you're paying interest. Pay your credit card in full so you don't have to pay interest. Save the money you want to put on credit and set up auto pay. One of the best things you can do is for those like little cards like a Target card or just cards that you're not really going to look at but you know you're going to have the money to pay into every single month, set up auto pay on them so you don't forget them. Even on some of the bigger cards, just set it up so that you're paying the minimum payment. Number 2 is credit utilization. That's 30%. Maintain low credit utilization. 30% or less is great. 0 to 10% is really good, optimal. Apply for credit limit increases. Apply for new cards. So with credit utilization, that's just how much credit you're using compared to how much credit you have. Another thing that I like to do just month to month is I like to I'm just gonna put my mouse over it, apply for credit limit increases. Every 3 to 6 months I'm constantly applying for limit increases, and I'm just calling all the banks, calling everyone I have a credit card with. What do I need to do to get a limit increase, or can I apply for an increase, so on and so forth. Credit history, number 3, 15% of your credit score is made up due to your history. You got to keep accounts open even if you don't use them anymore. So what that basically means is if you have an old card, let's say it's a student card, doesn't really have any value, no points, nothing, keep it open, buy a cup of coffee on it once a year, stick it in your card book or your drawer, and don't forget about it. And if you get a letter in the mail saying, hey, we're going to cancel this card, no, because that is the card that is holding all of your age. A lot of that old age that's contributing to your credit history is due to that card. So never close accounts, keep them open. And then credit inquiries. If you have my inquiry removal course, this is really not going to be something that you're going to need to worry about because you just remove your own inquiries. But hard credit inquiries occur when a lender checks your credit. You go to the car dealership, they'll run your credit like 20, 30, 40 times. I've seen in some disasters where it's like 60 times. I have no idea why and how they're even able to do something like that without your consent, but it happens all the time. And then if you're trying to buy a home, if you apply for a credit card, that's when a hard inquiry will hit your credit report, because that lets other lenders know that you've been looking for credit. Maybe we don't want to lend to you because you've been looking for too much credit. Maybe you're just going to default on it, so on and so forth. Next is soft credit inquiries. When you check your credit yourself or for non-lending purposes such as a background check, etc. So let's just say you're applying for a job. They want to check your credit, but they're not going to pull a hard inquiry, a hard credit. They're going to pull a soft credit inquiry. They're just going to make sure you're on time, no late payments, make sure you have no collections, and things like that. I know if you are becoming a police officer, for instance, they'll want to make sure that collection account that you may have or not have is paid off before they let you move any further in the process. So credit inquiries, if you're not following my rules, I limit it to 1 to 2 times per year if possible. Number 5 is the types of credit used. The least crucial of all these factors. I have about 23 credit cards and an open car lease, and I don't own a home, so I don't have that category taken. But we'll go over the 3 types. The first type is revolving, and I just noticed a spelling error here, so don't mind me there. Revolving is typically credit cards, and it could be other things. Generally, from what I've seen in the repair industry, anything that's listed as revolving is a credit card. The next is installment, normally home or auto loans. And a lot of times, let me think real quick. A lot of times when you go to like a furniture store and they have a payment plan, that normally is an installment loan from my understanding and from what I have seen listed on a lot of credit reports. And then the next thing is open accounts. These are usually charge cards or utility accounts such as a cell phone bill or an electricity bill. So with American Express, they have these great cards called charge cards. I use them in my business. And what they're able to do is they report monthly just a $0 balance, no utilization, no credit limit, but they do report as an account positively on your report. And really the only time they'll report anything negative is when you miss a payment. So this works for a cell phone bill. If you're paying your cell phone bill on time, but you're 30 days, 45 days late, you're going to get hit with a late payment on your credit report, even though it's not directly contributing to your age and the other factors of credit. And also utility bills like electricity, your gas bill, those are all factors that fall into the types of credit use category that can really hurt you and bite you in the butt if you're not paying your bills on time. So I just want to go over the main points of this video. So we talked about our payment history being 35% of our credit score, credit utilization being 30%, and then our credit history, how much credit do we have, and our credit inquiries, how many times are we applying for new credit, and then our types of credit used, which were the installment, open accounts, and revolving. Well, thank you for watching this video. Please subscribe for my next video, and just if you're interested in credit, I have a course in the description, and I have a ton of great videos on my channel that can really help educate you.